If you've recently embarked on the world of child rearing or are a seasoned veteran, you may have experienced the phenomenon of post Christmas wish list. This plays out in some form or fashion of a child completely forsaking all of the presents they just received on Christmas Day and immediately drafting up a new proposal of present request for the impending Christmas, which is 11 months away. It's a difficult task to remind them that Christmas is indeed coming, but practicing patience is going to be the best plan of action for the coming months. And FYI, Santa is watching. Perhaps we all have a similar wish list as we start 2023. In the mortgage world, we have pleaded that if we are all good boys and girls, perhaps we will get the gift of lower interest rates nearly wrapped up us under the tree with a little tag that reads, okay, to open before Christmas. Well, 2 weeks into January, Christmas seems to have come early. It was joyous as we watched Treasury yields plummet from the combination of both fundamental and technical cues to give way to a new horizon of trading range. Having secured a close below the 3.4% level on the 10-year, we now see the 3.4 as our new backstop with a support zone of 3.5%. The new line in the sand for further improvements now looks to be the 200-day moving average, currently at 3.29%. Overnight, we made a run at it, but the resistance zone is going to be one that will require further data to muster the momentum required to breach it. Although 3.29% will prove to be the formidable opponent, it's evident that the market has been favoring lower yields. And inflation easing sentiment is the biggest champion in this move. Where we go from here will depend on the data and the Fed speak. Of course, the looming Fed meeting on February 1st will also confirm the new range. Where we sit right now, a 0.25% hike seems to hold very strong conviction in our markets today. What a difference a few monthly cycles of data make in our overall well-being. Not too far in the distant past, we can recall how much angst there was when the market felt the extremes of policy tightening and fear that the interest rates were going to be in the mid eights or higher on a 30-year fixed rate. Well, thankfully, that plan that lay before took a fork. Today, our attitudes towards the new year are becoming more and more optimistic. What was merely a hope and prayer now seems to be confirmed that we are on the right track. Yes, the difference is all about the data. And the data says, happy day, the world is your oyster versus TGIF. I found another gray hair. Seeing some slight price weakening this week, mostly driven by the need for some consolidation off what has been a good distance of rate improvements. I find this slight move back higher a positive response if it gives the market time to take a breath, re-easing, and then dry our powder for the next move. Truthfully, we don't want to elevate or drop, as that would be seen as an alarm bell sounding. Instead, we want a uniform and steady movements that afford mindful consideration of each level the market's wanting to price at. The December producer price index PPI report showed that overall producer inflation decreased by 0.5%, which was much cooler than the negative 1% drop expected. Year over year, inflation declined from a downwardly revised 7.3 to 6.2%. This was much lower than the 6.8% expected and is a 1.1% drop from the previous reading. Think about the progress that's been made on the producer inflation side of things. This reading was at 11.7% at its peak and is now almost half of what it was. Now, the core rate, which strips out food and energy prices, rose 0.1%, which was in line with the estimates, but the previous report was revised lower to 0.2%. Year over year, core PPI declined from 6.2% to 5.5%, which was also cooler than expectations of 5.7%. Overall, inflation continues to subside and the bond market is rallying. Tina Mitchell here, and that is your Money Chat. Coming up